In this video, we will explore about the basics of cash flows and understand the reality behind the profits. We often look at the profit and loss statement and the balance sheet as the holy grail of a company's health. But there is a catch. These statements follow the accrual basis of accounting. This means income is recognized when it is earned, not when money actually hits the bank account. Similarly, expenses are recognized when they are incurred, not when you pay the bill. This creates an illusion. The reality lies in cash flow, where income is recognized only when received and expenses only when paid. This difference creates a gap between the profits you see on paper and the actual cash generated by the business. Let us visualize this with two scenarios. In scenario A, we have a cash business. You have cash sales of 1 lakh and cash purchases of 80,000. This gives you a clear profit of 20,000, which is real cash in hand. Now, look at scenario B, a credit business. You sell on credit, which is just an IOU, but you pay for your purchases in cash. The profit and loss statement will still show a profit of 20,000, but this is a paper profit. In reality, you have no cash. If you cannot collect the dues from customers, even your initial capital of 80,000 is lost. To make sense of how money moves through a company, we divide cash flows into three distinct buckets. First, we have operating activities, which cover the core business operations. Second, we have investing activities, which deal with buying and selling assets. And third, we have financing activities, which involve raising capital through loans or equity. In this system, cash inflows are positive and cash outflows are negative. Let us look at operating cash flows first. This starts with the net profit figure from the profit and loss statement. However, since net profit includes non-cash items, we have to adjust it. We add back non-cash expenditures like depreciation and amortization. Then we adjust for changes in working capital, such as changes in accounts receivable and payables. The result is the operating cash flow, which tells you how much cash the actual business engine is generating. Next is investing cash flows. This section reflects the company's growth strategy based on balance sheet items. When a company buys assets like machinery or land, money leaves the company, so it is a negative cash flow. Conversely, when a company sells its assets, money comes in, resulting in a positive cash flow. Ideally, a growing company will have negative investing cash flows because it is spending money to expand its capacity. The third bucket is financing cash flows. This shows how the company funds its operations and growth through liabilities. If a company borrows money from a bank or issues new equity shares, cash comes in, which is positive. However, when the company repays its debt or redeems equity, cash goes out, making it negative. This section helps you understand the company's relationship with its lenders and shareholders. Now, you must watch out for a major warning signal. If a business shows continuous negative operating cash flows for several years, it is a high-risk situation. It means the core business is not generating money. To survive, such a business needs continuous doses of stimulus, either by borrowing more money or selling more equity. Eventually, one of two things must happen. Either the business turns positive or it dies down when investors and lenders refuse to pump in any more cash. A classic example of this is Kingfisher Airlines. They fell into a vicious cycle. Their earnings before interest and tax, or EBIT, was consistently lower than their interest obligations. This forced them to borrow more money just to pay the interest on old loans. The business failed to turn positive, and eventually lenders refused to provide further cash infusion. This proves that no business can run on the continuous expansion of borrowed money forever. Let us look at the numbers for Kingfisher Airlines to see the severity of the situation. In March 2013, They posted a net loss of 4,301.12 crores and their net cash from operating activities was a negative 1,390.86 crores. This trend was consistent. In March 2012, the operating cash was a negative 885.55 crores. Even back in March 2010, it was a negative 1,665.09 crores. When you see a chart where the bars are consistently pointing down for years, it is a clear sign of trouble. This brings us to a crucial lesson about financing expansion. When a company borrows heavily to grow, it faces a risk mismatch. On one side, you have the book value of assets. If the company fails, the realized value of these assets may be far lower than what is shown on the balance sheet. On the other side, you have debt obligations which must be met in total. Lenders don't care if your asset value drops, they want their full money back. Therefore, always be cautious of businesses that depend excessively on borrowed funds for expansion. As we wrap up, keep these points in mind. First, looking at the net cash flow number alone can be deceptive. A positive total could hide a bleeding core business if the company is selling assets or borrowing heavily. You must analyze each stream, operating, investing, and financing independently to get the true picture. Finally, think of your analysis as a funnel. Start with the total cash flows, but then apply a filter. You need to adjust for non-recurring or extraordinary items that distort the numbers. Your objective is to identify the sustainable and recurring cash flows that the company can generate over the long term. This filtered view is what truly determines the value and survival of the business.